Yeah, I'm losing my
We're going to
edge.
talk about hedging long-term investments, specifically in the stock world. You can theoretically hedge anything. You could hedge your garden bushes. You could but you can hedge any part of your portfolio.
Really are on the edge today.
It's most common in the equity world because most people accumulate large investments of equities through 401ks, through gifts. As I know, my parents, for some reason, I think one Christmas, like bought shares of Disney in my name, which was really exciting as a 10-year-old. But this is primarily what hedges are used for, is long-term investments in stocks. That's what we're going to look at. But the idea transfers to really anything. I mean, even now that gambling has become more of a thing and it's being normalized into society again after being kind of nixed for the last couple of decades, you talk about hedges in that industry too, right? Where it's like, okay, I chose the Bears over the Packers in this game. The Bears are up by 3 touchdowns at halftime. I can hedge with a small investment in the Packers now at 5-1. You know, it's as easy as that, where it's like I laid out $100 on the Bears. They're up by 3 touchdowns at halftime. I take, a $10 investment on the Packers at 5-1. If the Packers win, I only lost $50 now because I made back that 5-1 on the $10. If the Bears win, I've locked in that $50 profit to the upside with the lower risk now. It's hedging, man. It can be
good analogy. I like that. Very well.
Did that work? You don't even watch sports. Did that work for you?
Yeah, actually it did. The only thing you got wrong was if you bought the 5-1 at $10, you actually made $90.
Wait, what? 5-1 at $10. Yeah, I don't know. Oh, yeah, I don't know. I screw the stuff up.
It's okay, but all good.
Well, I think where I really got it wrong was that the Bears would be up 3 touchdowns at halftime. But yeah, let's look at it within the stock world, which is probably going to translate a little bit better to people watching this show. So futures, Pete, offer a cost-effective way to reduce investment fluctuations in times of stress or fear. This is more the textbook version of what I just talked about with NFL teams and gambling. And it's just a matter of, we looked at this a couple weeks back, Pete, just taking this line here and saying, okay, I own a stock index, or I own my own basket of stocks, but usually probably has a high correlation with a stock index like the small stock 75. I want to reduce these fluctuations a little bit. I want to take this, this ride from 55 down to 30, and now in the middle range there, I want to reduce that to a ride up to 50, down to 40, and then settling in the middle there. And that's what you're trying to accomplish, right?
Absolutely. You know what? It's active management of your portfolio it's providing yourselves another set of opportunities. And honestly, I thought the betting analogy was great because it spoke a very, you took something off the table there and you did it in a very efficient manner. That's what you're doing here, is you're just taking something off the table. You're not sterilizing, and I use that word and it's just a confusing word. You're not completely neutralizing what you have on. You're taking something off the table when it's performed in a way you've wanted it to do so.
Well, and a way that
go ahead.
Sorry. Well, a way that I usually like to term that is like you're locking in some profits, because you usually what you don't want to do is show up on day one and immediately your investment moves lower by 10%, and then you start hedging it while you're in the hole. The theory is to, this chart isn't going back to 2016 and 2017, where this stock market in the small stock 75 would have been around $20, $30, and now has risen up to a $55 value. That's when it's like you said, take something off the table. Or in my head, it's like, all right, let me lock in some of these profits. Okay, I've made the money, like in that analogy, I bought the Bears at even odds. Now they're, minus 600. They're overwhelming favorites, I can take a little of that off the table without seeing this through to the end of it. And with investments, it's much more difficult because that Bears game ends at some point, and I either made the money on the Bears or I
That's a
lost it,
good
and
point.
my
I didn't
hedge
think about it
helps.
then.
But
Yeah.
with investments, this stuff is
Yeah.
going on for a lot of people for the
Sure.
entirety of their lives, usually to up until your retirement or when you decide to uproot your investments. And so hedging is really important to taking something off the table here and there, because anyone who knows anything about markets and cyclicality, there are times of bullishness and there are very fearful times of bearishness. And so it's a matter of, okay, we've had 3 or 4 bullish years, and we tend to, on average, see, anywhere between 3 and 10 bullish years before a real correction. I want to take something off the table without, like you said, Pete, the biggest extreme of that would just be, I'm going to sell everything I own. And most people don't want to do that, because say you have a long-term investment for 50, 60 years, you're going to hit probably 3 or 4 significant bumps along the road there. And to say that every 5 years, I'm just going to take everything off the table and then put it back on afterwards, and then take it off and then put it back on. I mean, that's not sustainable. When you talk about 401ks, it's very difficult. When you talk about other investments that are less liquid, it's very difficult, very difficult. And so this is, to me, the easiest way to do it, especially with small exchange products that are small by nature, allow you to get very granular with how much you want to hedge and the efficiency of them at the end of the day. To say, in the example that we're going to see here in a second, you've got maybe like a $15,000 investment. If you want to take a third of that off the table, it would be about one short smalls contract via this math here. And that's only going to cost you in buying power a few $100s,
Right.
whereas the time it would take to take a third of that investment completely out of your portfolio, or to do that in stocks or to do that in options, much more capitally intensive. So it's easy with these smalls in terms of capital, and in terms of how small you can get. Because Pete, a lot of times, what you'll see, the last thing you want to do, Pete, is overhedge. And with
Right.
traditional futures markets, sometimes you're going to need an investment that's over 50 grand. Sometimes at this point, if you wanted to hedge with the E-mini NASDAQ, you need an investment that's over 200 grand to just hedge 100% of it. So you can't scale in, you can't get more granular with it, right?
No, and that's the challenge. So, you've got a $200,000 product that really doesn't fit. So it becomes a binary choice. Well, I'm going to take them all off, or, and you make a good point. If the market continues, to move higher, you've really, at that point, you've neutralized your entire position. In my mind, that's not a hedge.
Yeah.
You've probably inefficiently substituted a basket for your particular portfolio, which really doesn't accomplish what you want. You run the risk of overhedging, and you run the risk of that. If you felt like, okay, this hedge neutralized my position, it really didn't. At that point, you're right. If you're looking for that complete neutralization, it's better to liquidate the portfolio and start over.
Yeah, exactly. Like with that betting analogy, it's literally just like at halftime, just there's secondary markets now for gambling, which are very intriguing. You can just find someone to sell the ticket to, like just at that point, just get rid of it,
Right.
like there's no point. But as we'll see here, hedging, there's a lot of points to, and you'll see in 2020, a very intriguing case for having hedged. And at the start of 2020, I think a lot of people would have agreed this is probably a good time to hedge, because timing is a big thing here. And when you see a stock market perform like it has the last 3 or 4 years leading up to 2020, certain stock indices up, 40%, most benchmarks up between 20 and 30 and 40% there. That's probably a good time to take something off the table,
Right.
right? That same analogy, like you're up 3 touchdowns, man, take a little bit off. And so the timing here is definitely a big part of it. At the end of the day, I would say hedge whenever you feel your investment is most vulnerable. Like there's to me, the only wrong answer in hedging is if you, like, for instance, in that example, if you bought here at 40% higher in the stock market after the last few years and then decided to hedge at the lows, yeah, that's not a great plan to hedge after a 50% depreciation. I would usually wait for some kind of bounce back in that investment. But to me,
You make a great point there, Frankie. But on that way down,
well, yeah, like something like this.
there were several spots, and this is where we talk about the size of the hedge. If you took away everything to the right of where you are right now, you would have said, boy, I don't know if I want to sell that break. That's a pretty substantial break. Why would I start that? Or why would I hedge? And when we talk about a hedge, that is, again, a percentage of what you have. Now that you would have looked back in hindsight and said, oh, the 20% I hedged there was a good decision. And you might have added some more. Now, you always run the risk of your hedge being at the low. That's why we always under hedge and do it incrementally. So if our location isn't optimal, we are still, we've maintained our idea. We've afforded ourselves some protection. Now, you could argue where you are right now, that was a great hedge. Look what happened afterwards. None of us know what's coming to the right of that die.
Totally.
But you would have taken something off, and honestly, you would have been more inclined to probably add another unit somewhere down on that chain. Now, if you look back, both of those would have been underwater, sure, but they accomplished what you wanted to do, is take some stuff off if we actually sat at those levels. So I think that you're never going to pin your hedge at the high. And sometimes your hedge is going to be put on at less than an optimal area that you realize a week later. Well, that's a week later. You never realize that in the moment. So the multi-step process of a hedge, I think, is critically important. And if you're going to look at it that way, how can I easily do that? No. And that's where the challenge comes. Give me a product that lets me incrementally hedge and do so in a very capitally efficient manner. And then I think that's what Small Stock 75 accomplishes.
Yeah, you raise a great point there. And it's kind of the duality, I guess. The dual mind of hedging to me would be, okay, try to have the awareness that if your investment has run up, if your investment was expected to move higher by 7% annually and it's moved higher by 15 or 20%, that's probably a signal to me to put on a small hedge.
Right.
That's to me an idea of this investment being vulnerable. But also, Pete, you're totally right that vulnerability also comes in something like this or something like this down here even, which would have been underwater. Like you said, yeah, it would have been underwater within 2 or 3 months, that hedge. But that vulnerability comes from outperformance. It also comes from shakiness in the market. You're totally right. It's just a matter of having a product like the Small Stock 75 that is smaller, that affords you the ease to put on and take off that hedge without having to make a big deal of it or put forth a lot of capital. And so I wanted to run through a couple of scenarios here. So here is, if we were looking at an investment, say you had $16,000 invested at the start of the year in 2020, that would be one micro E-mini S&P contract. That's your long stock portfolio. Now, say you left it unhedged all of 2020. You're only down about $240 as of right now, but you saw losses exceeding $5,000. And a lot of people would say, hey, but I'm only out $200. If I had hedged, that would have been stupid. It would have been a waste of time because it's back to $200. Yeah, but once again, to Pete's point, you don't know what's going to happen in these moments. And also, you don't know what you're capable of doing when you're out $5,000 on a single micro E-mini contract here. When you're down, Pete, almost 30% on your investment, you might be thinking, well, man, I need to get out of all of this. You just, to take that amount of heat on an investment that is supposed to be long-term, it's just not really good for anyone. And I would actually make the opposite case of, oh, it's a waste of time. No, if you were just slightly more active and getting a hedge on, it really is a matter of calculating how many contracts just via your portfolio value piece, right? and the percentage. That should only take you hopefully a few minutes to a couple hours for the worst mathematicians out there. And then implementing the hedge in the marketplace, which via different brokerages and trading platforms should be relatively, hopefully, easy for you. If you took that slightly active approach, Pete, and you, in that other scenario, wasted a couple of hours of your time, Pete, you would have saved yourself a ton of emotions here at the lows, a ton of stuff that works into your working life, that works into your other trading life as well. And putting on one of these short contracts, small stock 75 contracts at the start of 2020 here would have, first of all, and this isn't something that I'm trying to celebrate, it would have gotten you $200 in profits. It would have flipped you from negative to positive in your overall P&L. And Pete, look at here, taking out what would be 30% of this initial investment would have taken that max loss from above 5,000 to under 3,000.
Right.
So being slightly more active, yeah, it turns you from negative to positive, but that's more just like a function of small stock 75 underperforming S&Ps. So I'm not going to like really try to make a case for that. But that one little bit of activity would have taken this downside here that you saw. It would have dropped it to something a lot more manageable.
Yeah, absolutely. And and I think you make a great point. None of us know what's going to happen to the right of the last dot on that green line. Once you do put that hedge on, you're not compelled to ride it all the way back up to the top. You will manage it at certain points when conditions change. But
Sure.
you want to afford yourselves options. None of us knew in March what was going to be, fair value is always, nobody quite knows what fair value, but nobody knows what value was going to be at that point.
Sure.
The function of the hedge is not to take a 25% winner and make it a 30% winner. What it is trying to take a 25% winner if you were long stocks and keep it at 18% or 19%, not have it go back to zero, God forbid negative. So that, you've got to keep that context in mind. It is a tool to help maintain profits or mitigate losses. It's not its own well of profitability within it. So
yeah,
look at it as a tool for managing that and managing exposure. And it's a dynamic tool. Doesn't mean you're managing that hedge every day. I think if you're managing a hedge every day, you're not using it as a hedge. But putting context around the ability to take uncertainty out and pull some chips off the table is a great analogy, Frank. You're spot on.
So yeah, this is something that I would also, the way that you stated it there is a matter of, okay, taking a 20% return in a given year. And yeah, at the end of the day, most hedges are probably going to cost you, if that's what happened from day one to day 365, that hedge is probably going to cost you a couple percentage points. But what the goal is, if S&Ps end up being 20% higher at the end of the year, you got maybe an 18 or 17% return. And at the largest drawdown, instead of being 30% lower, it was only 15% lower.
Right.
And yeah, it's this old thing that I think a lot of people have probably seen with different ETFs or wealth management packets of information, or even a lot of research on Tom and Tony's morning show, which is risk and return. Okay. And with different ETFs and different investments that you could take part in, different option strategies you can look at, it's going to show, okay, this one's got a lot of potential return, but it's also got a lot of potential risk.
Right.
And, choosing an ETF to invest in or an option strategy to subscribe to has those, do I want to sell the straddle with a lot of potential return and a lot of risk, or do I want to sell the strangle with a good potential for return and much less risk? What's nice about this, Pete, is that you've got your investment. I can reduce risk and thus also reduce a little bit of that potential return on the fly. I haven't gone in there and said, okay, I'm buying this ETF and I'm not going to mess with it, and it's got this potential risk and return for the rest of its life, you can put these hedges on and reduce that risk and return at any point. And that's just how it's going to go. But I wanted to show this a little bit. If you did sell two of these contracts, you would have actually been up $700, and your largest loss would have been under $1,000 here. And I wanted to show this more. And to our gambling case, this is like if someone tried to kind of middle the market, which would be the scenario of you have the Bears and then you buy the Packers at halftime plus the points, and you want the Bears to both win the game and the Packers to cover the spread, and you kind of make money on both your investment and your hedge. It's something that that rarely happens, but actually has kind of happened this year, where you reduced, if you had a $16,000 investment in the S&P 500 and you sold two contracts against it, which would have in essence taken out about 60 to 70% of that investment, you would have both reduced the risk here and made more money than the initial investment or hedged by one contract. And to leave off on the segment, Pete, what happens if I sell one more contract? Well, that just gets me to a fully hedged position, which,
Right.
Pete, just gets me to a pairs trade, right?
Yeah,
So just
absolutely. At that point, and I'm glad you walked, Frank. I'm so glad you mentioned that. That's exactly what you get.
Yeah, because it's nice to kind of see this stuff, how it pans out. Like in futures, people think there's so much complication. There's different contracts. It's an obligation to buy or sell this thing. No, it's just a couple of different products that move up and down. And a pairs trade is in the same realm as a hedge, in that, okay, if I have one long micro E-mini S&P contract and I sell one against it, that's a hedge of 30%. I sell two against it, that's a hedge of 60%. I sell three against it, that's 100% hedge or a pairs trade. It's kind of fun to take all these tools for hedging, for pairs trading, all these different strategies, and see that they're actually really simple instruments that are part of the same organism. Right. So today we're talking about hedging. Yesterday we were talking about pairs trading, all part of the same organism, but hopefully now you know how to do both.
Fantastic.